Hello everyone, welcome back to Rajeshwari's Commerce and Management Study App. I am Rajeshwari here. Let us understand today cash flow statement. Before understanding the cash flow statement, let us understand where and all it is applicable, where it is mandatory. Applicability you need to understand before preparing any statement, because cash flow statement, when you are preparing the final accounts, it is also one of the statement with balance sheet, income statement, changes in equity, then cash flow statement you are preparing. And as per accounting standard 3 you are preparing, the accounting standards 3 also says it is mandatory. For whom and all it is mandatory? See, it is mandatory for all the industries except small and medium companies, level 2 and level 3 entities. Corporate entities, we have level 1, level 2, level 3. For level 2 and level 3 entities, it is accepted. And as per the Companies Act 2013, cash flow statement is prepared by the all the company. It is mandatory for preparing all the companies, but except we have doormat company, private company, one person company, that is sole trading concern, small companies. Except this, rest all the companies, it is mandatory to prepare the cash flow statement. And why we need to prepare cash flow statement? Is it necessary? You are preparing income statement, you are preparing final accounts, right? That is enough to understand the financial position performance. Then why we need to prepare cash flow statement? See, cash is the lifeblood of the any organization. If they are not able to manage with the cash, then they won't be able to run the business successfully. If they are generating profit also in the business, but still if they are failed to manage the cash flow, then it is impossible to survive in the market. How companies are generating and how they are using the cash, you need to understand. That is one of the important objective of preparing this cash flow statement. And your future is depends on your present condition, present situation, right? So present situation, how you are understanding? Because income statement you are preparing on the accrual basis, and whatever profit it is shown, it is book profit. That is not the actual profit. Actual cash flow you need to understand by preparing this cash flow statement. So your future requirement, your future decisions will be depends on your present condition. For that you need to prepare the cash flow statement. And ability to generate cash. How much what is your ability to generate the cash? And liquidity and solvency. To understand the liquidity and solvency, you are preparing the cash flow statement. What is liquidity? Liquidity means you can convert the asset which you are holding it, you can convert them into a cash within a shorter period of time. That is within 3 months or equal to 3 months. Then solvency. Solvency means your obligations. You have created the obligations. How you are meeting your obligations. Example, debentures. Outsiders, you need to repay the amount, right? Debenture holders, creditors, these are all you need to repay. So this your solvency positions will be calculated based on your cash flow statement. To understand that, we are preparing the cash flow statement. And why we need? For the operations, already we have discussed, right? So for operation, to understand the operations, and you to pay your obligations, to understand where you are, how you are, where you want to be, how you want to be. See, these questions will be answered in the cash flow statement. And cash basis, you are preparing the cash flow statement. Cash flow statement you are preparing on the cash basis. Now, here you need to understand what is cash means exactly in the cash flow statement, because what you have in hand only, not only that will be considered as a cash. Under cash flow statement, cash includes cash and cash equivalents. Then marketable securities. Securities. Then we have short term, short term securities. Readily convertibles. Government securities. Fixed deposits. See, these are all you will call it as a cash only. Here you need to understand this. Cash means not only cash what you have in hand, cash includes the cash equivalents also, marketable securities, short-term securities, readily convertibles, government securities, fixed deposit. Then what is flow? Flow means whatever it is running, it is called as flow. The constant whatever remains, that you won't call it as a flow, right? So here flow means changes. There will be increase in flow or decrease in flow, increase or decrease in the flow. The changes you are recording in the cash flow statement. Example, if you have 2023, 2024, your debtors were 10,000, 15,000. You are not recording either at this 10,000 nor this is 15,000. You are recording the difference 5,000 you are recording. The difference 5,000 you are recording. That is why under cash flow statement, the changes will be recorded. The cash and cash flow, the cash balance, opening balance will be given. Your closing balance, you need to match with your closing balance of the cash. Statement means it is a document. And this cash flow statement have classified into three heads. The first one is cash flow from operating activity. Operating activities. Cash flow from investment activities. Last one, cash flow from financing activities. Let us understand the format. You should never by heart the format. You need to understand three heads. And cash flow statement. First I am writing all the heads we have classified into three. The classification I am writing: cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. You will never forget. Just believe me, if you watch this full video and at the end of the video you will feel that yes, cash flow is very easy. Financing activities. Now, operating activities, investment activities, financing activities. We'll start with financing activities because any company, if you are started any business, how you are starting your business? by raising the funds, capital, right? Without that capital, you cannot start the business. We have four factors of production. One of the factor is money, capital. So that capital you are investing. How you are generating the funds? Through by issuing the shares. When you are issuing shares, it can be equity share, it can be preference share, it can be debentures, but you are issuing. Whenever you are issuing, cash is coming into the business or going out of the business. Here you need to understand cash inflow means it is receipt to the business, whatever cash coming into the business. Cash outflow means it is payment to the business, whatever going out of the business. That is cash outflow. Inflow, receipt, whatever coming into the business. Outflow, it is payment, whatever going out of the business. Remember this. Here you have to do based on that only. Inflow and outflow you are going to check. Issuing of shares. Issuing of shares. It can be equity share, preference share, or debentures. What you have to do? It is plus. You have to add. Right. Then you have borrowed the loan. Only capital is enough to run the business? No, it's not possible. You need to have a loan, borrow the loans also. You borrowed the loan. Cash is coming into the business. So what it is? It is add. Now, you issued the shares, preference shares and debentures. After a certain year, you are going to redeem. Whenever your redemption of shares, redemption of preference share. Now, redemption means cash is you are paying to the you shareholders are paying to the business. Redemption means what? Cash is going out from the business. So what you have to do? You have to minus redemption. Then redemption of debentures. Redemption of debentures minus. Now, while issuing, I told you that it can be equity, it can be preference, it can be debentures. If it is preference, equity, and all what you are paying, you need to pay return to the shareholders, right? Dividend to shareholders. Dividend you are paying. Is this add or minus? It is minus. You have debenture holders. Interest you need to pay them. Interest minus. Right? Then you borrowed the loan. You need to repay the loan. Loan paid. Loan paid. Understood? Whatever cash coming into the business, cash inflow into the business, you are adding. Whatever cash going out of the outflow of the cash, you are minusing. This is financing activity. This is from financing activity. Now let us go for investing activity. Now you will do investments. I told you four factors of production, right? It's very important. Now we have capital we covered. Land, right? Land means investment activity. You have invested on machinery. Machinery. You purchased machinery. When you purchase, cash is going out or coming in? It is going out. So minus. Building. Purchase. Minus. You sold building. Sales. Sale of building. Cash is coming in or going out? It is coming in. All investment. You have done investment in another company. Investment. Investment you have done. Right. For that you are receiving a dividend received. Investment. You cash is going out or coming in? Investment you have done. This is cash flow from investing activity. All fixed asset purchase minus investment sales add. Investment dividend you will now investment you have made. For that you will receive dividend. dividend, add, because here you are receiving, here you are making payment to the shareholders, here you are also a shareholder, you are receiving interest, you are receiving, you have done investment, interest received, you have building, you have received rent. This is all comes under investing activity, investment, whatever investment you have done. Now coming to the cash flow from operating activity. Cash flow from operating activity. Now what are all remaining? It is very easy. Just you need to understand. Your balance sheet is there. Balance sheet. Fixed assets, investment, current assets. These are the three heads which are going to come. Here, shareholders fund, long term loans, then current liability. Under shareholders fund, we have reserve and surplus also. This is done under investment activity. This is done under investment activity. Shareholders fund is done. Loan is done. Which are remaining? Reserve and surplus, current liability, current assets. This comes under whatever remaining, you just write under the head operating activity. Right? And operating activity starts from net profit as per your profit and loss account. Whatever net profit is given, with that you are adding. Then current assets, we have all non-cash expenses. Non-cash expenses. Non-cash expenses means depreciation, goodwill written off, preliminary expenses. These are all non-cash expenses. All non-cash expenses you are adding. Non-cash expenses, goodwill written off, preliminary expenses. Preliminary expenses are the expenses when you are starting your company, when incorporation of certificate is done, no, that time before starting any expenses arises, no, that will be called as the preliminary expenses. Preliminary expenses. Loss on sale of fixed asset. Profit on sale, you need to minus. Operating activities. Under operating activities, after this I am continuing here. Operating activity, see, just see, operating, you will get after all this operating profit before working capital. Current assets and current liabilities are remaining now, right? So that you are going to take now. Increase in current assets, you need to minus. Decrease in current assets, you need to add. Increase in current assets, you are minusing. Decrease in current assets, you are adding. Increase in current liability, this is immediate effect you are going to see. See, current assets, why increase in current assets we are minusing is, now debtors means what? Oh, your customer. For credit sale, when credit sale happens, your debtors will be created. Now, immediately you are not receiving. You are going to receive later. Once it is paid, your debtor will be less. So that is why decrease in current assets we are adding. Increase in current assets we are minusing. This is only accrual basis. Remember, accrual basis. This is cash basis. Whatever cash you have received immediately in your hand and equivalent to cash, that you are going to consider. Increase in current liability, you are adding. Increase in now bills, payable, it is increased. That your expenses you are adding. Increase, decrease in current liability you are minusing. Then you will get cash generated from operating activity. Then from this you need to minus the tax paid. Tax paid you need to minus. Tax paid. At the end here you will get all these heads, whatever you have calculated, positive or negative, that you are going to take. Then you will get your opening cash, closing cash balance. It tallies. This is the format of the cash flow statement. I hope you all understood the format of cash flow statement. Don't buy heart. Never ever buy heart. Understand why it is recording, when you are recording, how you are recording, why you are recording. If you answer to these questions, then you will never make mistakes. You will not get confusion. It is one of the easiest chapter. So that is why. I hope you all understood. Thank you for watching. Have a great day.